Good afternoon. My name is Desmond Lochman, and it's my pleasure to welcome you to this afternoon's event on coping with the COVID-19 pandemic in the emerging market economies. It's my particular honor to welcome our panel of highly distinguished economic experts to this afternoon's session. I can't think of a more qualified panel to shed light on this important question. In the order in which they'll speak, they are Ayaan Kosi, who's the acting vice president in the World Bank's Equitable Growth Finance and Institution Practice Group. Ayaan leads the World Bank's analytic work on the global macroeconomic outlook, including the production of the bank's most recent Global Economic Prospects report. Ayaan will be followed by Alberto Ramos, who is the managing director and head of Goldman Sachs's Latin American Research Department. Previously, Alberto was a senior economist at the International Monetary Fund. He'll be followed by Petya Kova-Brooks, who's deputy director in the research department at the International Monetary Fund, where she leads the IMF's work on multilateral surveillance. And that includes production of the IMF's flagship World Economic Outlook report. And finally, we'll have Steve Kamen, who is my colleague and resident fellow at the American Enterprise Institute and was formerly director of the Division of International Finance at the Federal Reserve Board. Just parenthetically, he's the only one of us on the panel who hadn't worked at the International Monetary Fund, which might give him an advantage in this discussion. By way of introduction, allow me to say that the COVID-19 pandemic has dealt a particularly harsh blow to the emerging market economies, which now account for around half the global economy. Not only have those economies had to cope with a once-in-a-century health crisis, they've also had to deal with very low international commodity prices and reduced export markets in the advanced economies. As a result of that, the IMF estimates that in 2020, these economies, excluding China, declined by almost 6%, making this by far the worst year for the emerging market economies in the post-war period. In addition to the large loss in output, the emerging markets have suffered major deterioration in their public finances. Budget deficits have ballooned, while public debt levels have surged to record high levels. This has raised serious questions about these economies' ability to service their debts. However, this has not stopped large capital inflows into the emerging market economies, as world investors have stretched for yield in an environment of extraordinarily easy monetary policy by the world's major central banks. The emerging market economic outlook in the year ahead would appear to be particularly uncertain. The dark COVID winter that advanced economies are now facing and the delay in vaccine rollout in both Europe and the United States could make for a difficult first half of the year for the emerging market exporters. And prospects for vaccinations in the emerging market economies themselves look to be even more tenuous. However, conditions for the emerging market economies should improve in the second half of the year, assuming that they get the pandemic under control. They might do so as the advanced economies experience a strong economic rebound once most of their populations are vaccinated and once the large monetary and fiscal policy stimulus being provided to the US economy feeds through to the world economy. Another important area of uncertainty for the emerging market economies is how long the currently very favorable global liquidity conditions for these economies will last. While the world's major central banks are committed to keeping interest rates low for a long period of time, there would seem to be the risk that the very large budget stimulus program being proposed by the Biden administration will force interest rates higher, and we could get a repeat of the 2013 taper tantrum. Against this background, I have asked our panelists to focus their opening remarks on the following questions. A number of emerging market economies have resorted to greater exchange rate flexibility and unconventional monetary policy to cope with the economic fallout from the pandemic. How successful have those policies been, and what limits might there be to further use of those policies? A second question, as a result of the pandemic, many emerging market economies have experienced large increases in their budget deficits and public debt levels, which are now at record levels. How sustainable are these debt levels, and how likely is it that we'll experience another emerging market debt crisis? Third, emerging markets now account for around half the global economy. What spillovers to the rest of the world economy should we expect from an emerging market debt crisis? And finally, given the likely impact of the pandemic on long-term growth prospects, what should emerging market policymakers do to improve those prospects? And is it possible for them to erase the pandemic's damage in a few years? Before I hand it over to Ian, let me just remind viewers that they can submit questions on the form that they registered on, and we'd very much welcome any questions that you might have. So now I give the floor to Ian Kersey.
Thank you, Desmond, and let me thank American Enterprise Institute for inviting me to join this really distinguished panel and see a number of old dear friends, some of them after a long time. Let me share my presentation. I'm going to go through some slides here. I want to make sure everyone can see it. You can see the slides?
Yep.
Excellent. So we are going to talk about emerging market economies. Desmond mentioned that we have this flagship report called Global Economic Prospects. This report is mainly looks at the kind of the prospects for emerging market and developed economies. We released the report last month. I'm going to focus on 3 questions, and based on the analysis in this report, I'm going to try to provide brief answers to these questions. I'm going to, of course, try to address the issues Desmond raised as well. First question is, what are near-term growth prospects? The second one, how has the pandemic worsened growth prospects for the coming decade, is 2020s? And the third one, what are policy priorities? Throughout the presentation, I'm going to use this acronym, EMDEs, that stands for Emerging Market and Developed Economies. Let me start with the first question. What are near-term growth prospects? Now, we have all seen a sharp resurgence of the pandemic in the past couple of months. When we released our report in June, we thought that, the global community was going to avoid this second wave, in some cases, of course, some countries, the third wave, and things were going to be under control. Unfortunately, that optimistic prediction did not materialize, and we saw a renewed surge of cases in varying degrees in different parts of the world, but especially in advanced economies and in Europe, of course, in Latin America as well. Now, what we learned throughout the pandemic, the uncertainty is not just related to economics. Of course, it is related to health outcomes. Last year, however you look at it, was a disastrous year for the global economy. It was the deepest contraction since the Second World War, around 4.3% contraction for the global economy. For advanced economies, close to 5.5%, and for emerging market developed economies, around 2.6%. This year, we know one thing. Until the pandemic is under control, it is difficult to see a very sharp rebound. And that basically dictates our forecasts. When we think about these forecasts, it's important to think about the different scenarios. In our baseline scenario, for example, we are thinking this social distancing, the lockdowns and vaccination campaigns, they're gonna collectively turn back the tide of the pandemic in the first half of 2021. And by late 2021, the majority of the populations of advanced economies and major emerging market developing economies assumed to be vaccinated. Of course, given the hiccups associated with the initial stages of the vaccination campaigns, we just need to see how this is going to play out. So with this assumption, we are seeing a global economy growing around 4% in 2021. And this is, we are using market exchange rate weights when we aggregate country growth forecasts. Now, there is, of course, a possibility of a downside scenario. And that's basically is associated with the delay of vaccine rollout, infections remaining high, and it takes a couple of extra quarters to rein in the pandemic. Under that scenario, we might end up with a lower global growth all the way to 1.6% this year. In the case of this upside scenario, we are thinking a much faster and broader-based vaccination campaigns around the world, and then the global growth can go up all the way to 5%. Our baseline for advanced economies growth around 3.3%, for emerging market developing countries around 5%. This 5% number looks big, but we are expecting a very serious rebound in China around 8%, and that really plays an important role. If you take out China from the emerging market developing economy sample, growth number declines below 3.5% for that group. Now, I talked about output growth, but when you have these types of major disruptions, you need to think about investment implications of these disruptions. Growth of investment has been slowing all the way, since 2010, and with the pandemic, there was an outright collapse in investment growth. For the emerging market developing economies, that collapse was around 5%. But if you take out China, the number is even larger than 10%. When you have, of course, this 10% contraction, it takes quite a bit of time going back to the levels you had prior to the pandemic. And our current forecast suggests even 2022, emerging market developing economies, excluding China, they are not going to go back to the investment levels they saw prior to the pandemic. So against this background, we think that risks to the global outlook still tilted to the downside. In the near term, number one risk is, of course, the intensification of pandemic that can take different forms. We have these, new mutations we need to think about, the faster transmission, and then heavier impact on the patients. On the vaccine front, the big challenge is the deployment and intake. And there, if there are delays, as I mentioned, we might end up with this downside scenario. The other important risk we are looking at, financial crisis amid these high debt levels, and on the corporate side, the corporate bankruptcies, given the extensive forbearance measures, lax macroprudential interventions we have seen around the world. Over the longer term, the big challenge is larger than expected decline in potential growth. For the remainder of this presentation, I'm going to talk about these issues a little bit. Let me first talk about the challenge associated with elevated debt levels. What we have seen over the last year, a record increase in debt levels. At the global level, government debt to GDP now is hovering around 100%. In advanced economies, we saw the largest increase in debt to GDP ratio since 1970. In emerging market developing economies, we saw the largest increase since 1987. Of course, these 80s were the years these economies struggled with a number of debt crises. When you look at, of course, the capacity of carrying debt to revenue ratios, those numbers skyrocketed in emerging market developing economies. Even prior to the pandemic, debt levels were elevated. In fact, we released a study looking at the debt developments in 2010s, and the conclusion was that these economies were experiencing the largest, fastest, and most synchronized debt wave since the 1970s. Whether you include China or exclude China in the sample, this important observation doesn't change. It's not just the magnitude of debt, it is how broad-based debt is accumulated around the world, and it is how fast debt is accumulated. So far, I talked about government debt. When you think about corporate debt, there are significant challenges, and those challenges were also there prior to the pandemic. As I mentioned, as a risk, if these forbearance measures removed, and they are removed before a firm recovery established, there could be serious consequences for corporates given the elevated debt levels they have. Now, Desmond asked this question, is this a systemic problem? Yes, there are some emerging market economies, some of them are large, they have elevated debt levels. But the big challenge is in low-income countries. These countries saw a sharp increase in debt to GDP ratios, anywhere around 10 percentage points, as you see on the left. And if you look at these fragile low-income economies, they are even a deeper hole. More importantly, debt to revenue ratios, their ability to carry debt and pay back the debt is just much smaller now. Debt to revenue ratios increase anyway around 400% to 500%. This is expected. Numerator basically sharply increased, denominator contracted. And output levels are not going to go back to pre-crisis trend level anytime soon. With that, global community took some action. There is a debt suspension initiative already in place, and common framework, G20 and the Paris Club trying to implement now to address the possible defaults in these low-income countries. But more needs to be done, and I'll be happy to discuss these issues when we come to the Q&A. Desmond also talked about this surprising development in emerging market developing economies. Many of these economies employed, for the first time, unconventional policies in the form of asset purchases. When you look at the magnitude of these purchases, they are much smaller relative to the purchases in advanced economies. And on the surface, along with the unprecedented degree of accommodation we have seen, these asset purchases, in fact, stabilize financial markets, reduce the spreads, and help these economies. The question is that, can they sustain these types of policies? Is this the type of policy instrument they can reliably use going forward, as we have seen in advanced economies? There are serious questions. And those questions mostly center around the duration, scale, and scope of these asset purchase programs. In some cases, these asset purchase programs trying to finance large government deficits. In fact, countries are very clear about their objectives in terms of financing deficits. And we have seen this movie before in the 70s, 80s, and 90s. When these types of policies implemented, directly financing government deficits, the end is always ugly and associated with some type of financial stress episode. The bottom line is that as much as we welcome these new instruments, we need to make sure they are not impeding central bank independence, they are not impeding the main objectives of these central banks, and hard-won gains of credibility over the past 2 decades. It's going to be important going forward, be very specific about the duration, scale, and scope of these interventions. Let me turn to the second question. How has the pandemic changed growth prospects for 2020s? Now, what we know, and we know very well, when you have these types of episodes, these episodes translate into large and long-lasting output losses. So in 2020, the global economy experienced a recession. When you look at the previous global recessions, so 2009, 1991, 1982, these episodes translated into large and long-lasting global output losses. But the 2020 episode was different in terms of its scale and in terms of its, synchronized nature. We are now looking at global output levels, not going back to pre-crisis trend, pre-pandemic trend output levels anytime soon. And there are different, of course, calculations when you think about these, but we are expecting global output still be 5% below the pre-pandemic trend in 2025. Of course, I talked about this downside scenario. If those types of scenarios materialize, we will end up even lower output levels. There is this loss each year global economy is going to incur because of the pandemic. And those losses, as I mentioned, very persistent. In the case of emerging market developing economies, cumulative output losses over this 5-year period could end up accounting for 47% of GDP of these economies in 2019. So you basically erase almost half of GDP of these economies. Of course, this is an opportunity cost concept because of the pandemic. But more importantly, we need to think about the impact of the pandemic on potential growth. Even before the pandemic, main drivers of potential growth, investment, productivity growth, improvements in education, health, working age population growth had slowed. And that was well documented. In the context of advanced economies, there were all types of other headwinds associated with very serious slowdown in productivity and demographic challenges. Now, in the case of emerging market developing economies, we thought prior to the pandemic, there was going to be a decline in potential growth. So in 2010, 2019, potential growth averaged 5%. We thought over the 2020s, that number would be 4%. But as I already mentioned, because of the pandemic, investment collapsed. Human capital accumulation, of course, got a very serious hit as we see the kind of the challenges in terms of educating kids and very large, high unemployment levels around the world. And because of the pandemic, we are thinking that now the potential growth over the 2020s is going to be around 3.5%. There are different ways of thinking about growth in the future. One way to think about it is, of course, the potential growth. Another way to think about is long-term growth expectations. What do people, financial markets especially, think about growth is going to be 10 years ahead? And there, we already saw significant declines over the 2010s. In 2010, we thought that 10 years ahead growth in emerging market developing economies is going to be around 6%. Now, 10 years ahead growth, when we think about it, around actually 4%. So what happens after these types of episodes? Sooner or later, potential growth numbers are reassessed and long-term growth expectations downgraded. And we saw this playing out after the global financial crisis. 2010, there was a rebound, but after that, we repeatedly downgraded our short-term forecasts over a period of 3 to 5 years, and then, of course, downgraded our potential growth estimates. Let me turn to the third question. Against this background, what are policy priorities? What should be done? In the near term, the single most important priority is to make sure we are accelerating vaccine deployment through global coordination and making sure that we are reaching even the remote corners of the world and having a truly global vaccination campaign. Now, while we are actively employing this vaccination mobilization campaign, we need to make sure certain mitigation measures are in place. We still need to protect the poor and the vulnerable segments of the society and make sure we are keeping the economy, real economy, afloat and the financial sector stability in place. Now, all of these are easier said than done. So far, policymakers provided unprecedented support and put a floor under the contraction. And then, of course, now they need to think about how they can mitigate the long-term impact associated with the pandemic. And I think one important lesson is that policymakers need to find ways to improve digital infrastructure, invest in climate resilience, find ways to improve education to reverse the losses during the pandemic. And given pandemic is global, and at the global level, there are significant challenges associated with climate change, associated with trade, associated with finance and the tax policies. It's essential to work together and find the kind of the common, the policies to address the broader global challenges. The good news is that as much as we are expecting a decline in potential growth, we also know if policymakers undertake ambitious reforms in terms of investment, education, labor force participation, especially the female labor force participation, they can actually mitigate this slowdown in potential growth. They cannot truly erase it, but at least they can put a floor under it. Now, I talked about these long-term growth expectations. There is no question. Financial markets reward countries they undertake significant reform programs and undertake those reform programs credibly. And you see that in long-term growth expectations. These growth expectations are upgraded following these types of reform programs. Unfortunately, they are downgraded when policymakers avoid undertaking reforms and delay what's necessary. Let me conclude with a summary. I asked 3 questions. What are near-term growth prospects? We are going to have a recovery. There will be a rebound, but we think it's going to be a subdued one. Risk still tilted to the downside. Second, how has the pandemic worsened growth prospects for the 2020s? We were expecting a slowdown in potential growth. That slowdown is going to be more pronounced. And we are expecting repeated growth disappointments unless policymakers are put in place the types of growth enhancing policies. And that's the third question. What are the policy priorities? I think unless we find ways to truly contain the pandemic, single most important priority is to, make sure we are taking care of the health challenge, and that starts with vaccination campaigns. There are other priorities in terms of protecting the firms and households, and of course, in terms of financial stability issues, and thinking about the long term. I invite all to visit our webpage and look at the analytical products we have. We have extensive discussions of these issues and policy measures. But let me stop here. Thank you.
Thank you very much, Ian, for that terrific presentation, really very comprehensive, given us a lot to think about. Just before I turn it over to Alberto, there's one question I'd like to ask you about the risk of a debt crisis in the emerging markets. Did I understand that you're really only concerned about those low-income countries rather than the medium-sized income countries? I'm just looking at, when I look at the IMF fiscal monitor, I see that large countries, emerging market countries, I'm thinking of places like Brazil or South Africa or Saudi Arabia, running budget deficits, in double digits, something like 10% of GDP, and got record debt levels. So my question is, why would you not be very concerned that we're really going to get real stress in those economies, once the global liquidity cycle turns?
I think your observation correct. The last part of your sentence, the last sentence is the key. Global liquidity cycle turns, and it doesn't look like it's going to turn anytime soon. I am focusing on low-income countries, Desmond, for a single reason. The problem in these economies is well defined. Some of them are already struggling. Some of them are already unable to pay their debts. And there is awareness of that in terms of the debt suspension initiative, in terms of the common framework. Now, will these countries trigger a systemic crisis and have contagion to other emerging market developing economies? That has to be seen, because we know that financial markets can look at one country, assess the situation, and say, oh, another country is similar to this one, going through debt stress. Now, what is important, I think, for major emerging market developing economies is to understand the consequences of low interest rates, and the hope that they understand the consequences of low interest rates. Even interest rates are low, that doesn't necessarily mean that they are low for all these economies. I think we learned that very well in 2018. We learned that very well in 2030. So there are significant risks in some large emerging market economies. We need to attend to them. But from where we are, as we are getting ready for the spring meetings, as you know, we are really thinking about the low-income countries and the challenges there, because they are on the door knocking, and some of them are defaulting. So that's why I just focused on that. But I look forward to the exchange on large emerging market economies, and your point is very well taken.
Thank you very much for that answer. Let me turn it over to Alberto, and maybe we'd get a different kind of perspective.
Thank you. Many thanks, Desmond. Many thanks to the American Enterprise Institute. It's a great pleasure to be here and share the panel with such a distinguished set of speakers. I do not have a presentation. I have a few thoughts. I think Ian presented a very comprehensive, very insightful, presentation and outlook for the global economy, the emerging markets, the key risks and challenges going forward, and what to do in order to overcome, some of the encumbrances that are still probably limiting the performance of emerging markets. I know that after me, Petya will present also the official view of the IMF in terms of the global economy and the emerging markets. So I'm not going to bother you with a set of numbers about the global economy and EM. But the house view is quite constructive in the short term. We're quite optimistic about growth in the US, global growth, and growth in emerging markets. We think that there will be significant policy stimulus still in the pipeline, both monetary and fiscal. So far, rather limited evidence of scaring effects, basically significant damage to the potential growth of those economies, even though I have probably slightly, less optimistic view about it. And Ian presented, what I think is, compelling evidence that after significant downturns in activity, there is something that is lost in terms of the productivity and efficiency of these economies. In terms of EM, from a market standpoint, the market is trading quite well. The outlook in the short term is quite positive. The stars seem to have aligned for asset prices to overperform in the short term, because you're operating in an environment where we have certainly backloaded to the second half of the year, when the magic of the vaccination programs will unleash all that growth potential that is trapped, particularly in contact-sensitive services sectors. So we have an optimistic view on global growth, global trade, firmer view on commodity prices, the continuation of abundant and cheap liquidity, and also a backdrop of a weaker dollar. From that standpoint, the vector of external drivers that many emerging markets are facing, at least in the short term, it's quite positive. Certainly, this is not to be taken as the status quo, not to be taken that this is a reality that will endure. At some point, it'll have to normalize, and those tailwinds will disappear. And then some of the challenges that have now been papered over by that very supportive, short-term outlook will be, more evident, and to create additional policy challenges. Desmond, you asked about, if a combination of flexible exchange rate regimes and somewhat aggressive and in some points experimental monetary response, whether the jury is out saying it was a successful experiment. I think the answer is probably yes. It's maybe a little bit too early to tell, but at least they avoided a significant market freeze. Most of the central banks tested new lows, went beyond lows that had been established during the great financial crisis of 08-09. Many emerging markets are now operating with negative real yields. Some of them engaged in quasi-monetary measures, regulatory easing, regulatory forbearance, quite aggressive in providing liquidity in local currency, in foreign currency. So they were successful in easing financial conditions. And they were also, quite successful in stimulating growth. Quite the opposite of what was happening in the credit dynamics during the great financial crisis. In many places, we see credit growth expanding at reasonable rates, and financial conditions have eased quite significantly. There was also a very significant deterioration of the fiscal baseline. I would like to spend more time, discussing the implications of that. That deterioration took, is pretty clear at the flow level, at the stock level. At the flow level, we saw a very significant widening or deterioration of the primary fiscal balances. Part of that is a reflection of the working of automatic stabilizers. We had a record-breaking contraction of economic activity in the first half of the year that led to an erosion of the tax base. And on the spending side, there are also some automatic spending items associated with unemployment benefits and other. So passively, without any major policy response, one would have expected the fiscal backdrop to have deteriorated, and deteriorated, indeed took place. But then there was a quite aggressive discretionary policy response to mitigate the economic, the social, and the public health impact of the pandemic. It's interesting that actually countries that had no policy fiscal space ex ante were actually the countries that used the fiscal instrument the most. It's quite amazing. One would have expected that countries that had fiscal buffers, that had moderate, levels of debt, would have, more fiscal space and would be more keen to use it. But it seems that, quite the opposite. When you look at the data set, two things emerge. One is that actually countries that had no fiscal space, Brazil in particular, they were quite aggressive in using, fiscal stimulus to, to support demand and mitigate the social impact of the pandemic. And the other one is actually like almost a political partition, is this that center-right administrations were actually more keen in engaging in large fiscal expansions than center-left administrations. I'm not going to go into that. I'm not a political analyst. I'm not a psychologist. It's just an observation. It's a factual observation. And there's been also, because there was a deterioration of the fiscal stance at the flow level, while the GDP, contracted, because of the decline in inflation, the nominal economy contracted, that to GDP increased quite significantly. And that can have long-term consequences. There is the expectation, particularly for instance, like the official IMF numbers, that the deterioration at the flow level will correct reasonably well over the next few years, over the next 5 years. There has been a deterioration which is cyclical, which is the automatic stabilizers. There is a deterioration that I'll call it structural, but it's not structural in the sense that we have changed, the statutory taxes or other major structural changes in the economy that will endure over time. It's structural because it is not cyclical, but it's not structural in the sense that will be durable. The policy response, the discretionary part, will mostly be withdrawn, phased out during 2021. At least that's what we hope, right? So there is the expectation that as time goes by, over the next few years, starting in 2021, you're going to see a very significant improvement of the fiscal stance at the flow level. History does not support that view. We have been analyzing and doing a deep dive on fiscal issues, debt levels, and a number of things, and shows that after very large fiscal expansions, usually you don't go back, to the reality, to the status quo ante before these major shocks. That these shocks tend to endure, they have a long memory, and they tend to perpetuate themselves. For instance, the IMF assumes that there will be a 5% of GDP adjustment in the fiscal balances in EM by 2025. In the first 2 years, 2021, 22, most of it will be cyclical as the economies continue to rebound, the tax base recovers, and some of that discretionary part that impacted spending will be phased out. But after 2022 to 2025 is a purely structural improvement. And out of the data set that we looked at, 34 emerging countries, 17 or so will end up in 2025 with structural fiscal balances that are actually stronger than they were in 2019. When you look at, for instance, the most recent experience with large contractions of GDP, the great financial crisis, or even looking at periods of severe recessions, we don't see that. We see quite the opposite. For this great financial crisis, we saw some improvement of fiscal balances in 2000 and 2001, and then a slight deterioration. 5 years later, we will still see most of these countries had weaker fiscal positions at the floor level than they had before the great financial crisis, than they had in 2007. So we have to be careful that we may be baking in too much optimism that this is just light dusting that will disappear, that the fiscal balances will recover as we go forward. The other thing is that it seems to me that the political economy of fiscal expansions have changed in a dramatic way over the last few years. If you go back to the great financial crisis, most of the policy support fell on the monetary pillar. Very aggressive interest rate cuts complemented by very aggressive balance sheet expansion. You all recall, rates at zero, followed by QE1, QE2, QE3, Operation Twist, you name it. So you push the boundaries of experimental monetary economics. Some, concerned about the side effects of such a policy experiment, but the policymakers in general were quite comfortable in doing what they did. And the fiscal response was a lot more contained. So in terms of, the two major policy levers, a lot of the weight and responsibility to support the cycle fell more on the monetary than on the fiscal. This time around, the monetary repeated the same old trick. They cut rates aggressively and they provided liquidity and they engaged in asset purchase and balance sheet expansion, including, this experimental, which is no longer experimental, but some emerging markets also engaged in some sort of asset purchases, not that much in Latin America, but in some other countries at moderate levels. I don't think they overindulge. The risk of an overdose there, I think, is rather limited. But what we did a lot more is using the fiscal instrument. And it worked quite okay. And it may not necessarily be related to the fiscal, because when you look at the chart, including one that Ian presented, we had a record-breaking contraction of activity in the first half of 2020, because the COVID outbreak was a physical restriction on activity. This was not your garden variety real business cycle. This was not a recession triggered by financial excesses that leads to a credit crunch and basically brings the business cycle down. This was not your typical cyclical contraction. After a long period of expansion, you bump into resource constraints, cost inflation starts to percolate through the system. The monetary authorities have to tighten monetary policy. That reduces the demand for durable goods and investment, and you go from the expansion stage to the contraction stage. This was a physical restriction of activity. People had money, but were just too afraid to go out and spend their money because they were afraid of their own personal health. And some of the business that they used to patronize were no longer there. Restaurants and entertainment and Broadway and a number of things and sports and cultural events, they were shut down, right? Once you remove those restrictions, to activity, once the social distancing protocols were eased, we saw a very quick, fast-paced, V-shaped recovery. Of course, turbocharged by very significant policy stimulus, both monetary and fiscal. So the casual observer will say, hey, this fiscal stimulus worked wonderfully. We should do more. And we see that very clearly in the US. After spending $3 trillion, we are discussing about spending another $2 trillion. It used to be back in the day that we're talking about, fiscal packages in billions of dollars. We're talking about in trillions of dollars. So it seems to me that the political economy going forward, because the record seems to show, even though the association, may not be very strong, that strong fiscal expansions did the trick. To a certain extent, there was a lot of social pain, during the pandemic, but was able to cushion the income of low-income cohorts, of the most vulnerable. And going forward, not only will be quite difficult to remove the assistance, to some of those cohorts, but it will also be, they will be quite adept in using the fiscal again aggressively, to repeat the experiment of 2020 in order to support the business cycle whenever that is the case. Let me now go from, the story at the flow level, which I think it's too optimistic in terms of what is assumed in terms of fiscal adjustment going forward, to the stock. The flow may adjust faster or less so, but the stock will remain high. We'll see a lot less progress in bringing the debt stock down. And the key question I get from investors is, will EM experience, rolling debt crisis? Is the debt way too high that it will crumble under the weight of a very heavy debt load? And the answer is maybe, we don't know. But even if the answer is no, that does not mean that carrying very high debt levels is inconsequential. Actually, it is not. It is quite damaging. And on that topic as well, we have done extensive research that is in the pipeline that we hope to publish, relatively soon. When countries have very high debt levels, we have, solid econometric, evidence that they tend to grow less, which we can link to some of the thoughts presented by Ian about the impact that has on physical capital accumulation, on human capital accumulation. It could also be related to scaring effects during deep contractions, loss of skills, businesses that were financially viable, but they were not able to traverse, the crisis and emerge viable at the end of the crisis. So that reduces, probably potential GDP going forward. Those econometric results show that there is also significant non-linearity in terms of growth outcomes, average real GDP growth, and debt levels. When you cross, debt levels at around 70% of GDP, those effects on limiting or reducing potential growth become a lot more severe. So it's kind of, between 40 and 60, 65, 70, yeah, you can accumulate a little bit of leverage. You can use accumulation of debt and fiscal policy as a counter-cyclical policy lever. You accumulate that, then eventually you run primary surpluses and you pay the debt. So you can carry that burden is somewhat light. That does not have, even though the correlation is positive, it does not have a major visible impact on growth. But once you grow beyond 70% of GDP, not only do you increase the probability of disruptive events, but it tends to impact your growth performance. And many of the emerging countries today have already crossed that thresholds, which is concerning, because if many parts of the emerging world were already struggling to deliver acceptable growth rates, Latin America first and foremost, but Ian also presented evidence that growth in EM was already on a secular decline, even though I believe that in some of the charts that Ian shows, particularly for EM, that may have been highly influenced by probably the secular decline in growth in China, but I think the result still holds ex-China. The second piece of evidence or cost of having very high debt levels is that it reduces the fiscal multiplier. When you operate at very high debt levels and you need to use fiscal policy counter-cyclical again, because once you overcome this, you're not going to abolish business cycles. There will be periods of expansion followed by periods of contraction. It would be nice to have some fiscal buffers and the capacity to marshal fiscal resources to support the business cycle. The problem is that the fiscal multiplier at high debt levels tends to be much, much lower than what the fiscal multiplier is at lower debt levels. Of course, the fiscal multiplier is state contingent. It depends on, the business cycle and many other things, that the type of slack you have in the economy, policy credibility, and whatnot. But debt levels is certainly one of the variables that comes as very, very significant in those regressions. So we lose something. Even if you don't experience a fiscal crisis, I go back, you tend to grow less, and your bang for the buck of using fiscal policy to support the cycle, is reduced. Next time you need to use fiscal policy, it becomes a lot less effective. That is a loss of efficiency, one of the key policy instruments to manage the macroeconomy, and it should not be underestimated. The third point is the capacity to use fiscal and monetary policy to smooth cyclical fluctuations as well, to real GDP and to inflation. It seems that countries with high debt levels also tend to show higher volatility in terms of real GDP outcomes and inflation outcomes. And I already, mentioned that particularly on the fiscal, your capacity to use the fiscal instrument to smooth those volatilities to GDP or even to inflation, even though fiscal should not be used as an instrument to go after inflation, is reduced. So you should expect countries that grow more, that have a weaker capacity or have a less efficient fiscal instrument available, and they tend to experience high volatility, and high volatility is associated with risk aversion and is social, it's social welfare negative, and a number of other things. High debt levels, goes without saying, also reduces the fiscal space. If you have a very high debt level, if you push your debt levels from 70 to 90% of GDP, the next time around, it might be quite difficult to do the trick again and push it from 90 to 110, because the market may not tolerate that. And that's at that point where the rupture dynamics can actually emerge. So my favorite analogy here is, to kind of, provide a little bit of an illustration of that. Economies are dynamic things. Hopefully they move forward. We see, no matter how low it is, on average economies, they grow over time. And having too much debt is like someone puts a boulder, a big rock, on your back. And even if the boulder doesn't crush you, certainly it increases the risk that you're going to stumble somewhere along the road, and the boulder crushes you, and you have your typical debt crisis. The fact that you're carrying a boulder, the fact that you're carrying a big rock on your back, slows you down. You grow less. The fact that you're carrying a heavy load on your back makes you more erratic. If you're trying to maintain a steady path, you go left and you go right and you stumble. That's macro volatility. We have more volatility in macro outcomes, in real GDP, and in inflation. And the fact that you're carrying a boulder makes you less apt to adjust, which is the illustration of the loss of efficiency of the fiscal instrument. Like, as you go through time and economies face challenges and obstacles that you need to overcome, you may have to jump over something, a difficulty. The fact that you carry a boulder limits your capacity. You jump less high because you carry a boulder. So if you need to use the fiscal instrument, it makes you a little bit more limited. It may not be the best illustration, but that's the one I got. And let me just conclude with your last question about the medium to long term, prospects. What do we do? I mean, we don't need to reinvent the wheel. At this stage, we already know what works, what doesn't work. We need to reform, integrate to global trade, stable and regulatory framework to attract investment, educate, increase, human capital. That's the recipe for EMs. That's the recipe for everybody. Indian growth is about capital accumulation, punto. There is no David Copperfield trick about it. If you don't invest, you don't grow. That's the challenge. Ian kind of reminds us very well, after this crisis, capital accumulation slows down, scaring effects are out there. And I can tell from my own kids that there is some loss of human capital accumulation as well. Let me stop here. I'm very eager to hear what other speakers have to say and the questions that the audience may have for us.
Thank you very much for that. Petya, would you like to?
Yes. Hello, and thank you again for inviting me here. It's a real pleasure to be on this panel and to be able to share some of the thoughts on the issue. Let me just share my slide deck, and while I do that, I also say that we've just released our World Economic Outlook update, but I'm just going to use that as the context setting for some of the questions that were asked at the beginning, and focus on one theme, which I hope complements what has been said so far, which is that we are in the world of divergences. And what we have seen so far with this collapse in output last year, we are now thinking that the collapse was not as dire as what we had previously thought in the total forecast the total number that we had for last year was global growth at minus 3.5. For emerging markets, including China, it is minus 2.4, and we have a slight upward revision to the forecasts for this year, global growth at 5.5, and the corresponding number for emerging markets, emerging and developing economies is 5.5. But what this is not showing you, what you don't see in these figures, is the fact that we do have very incomplete recoveries. And one way to illustrate this is to show just the number of economies that have declining per capita real GDP relative to where they were in 2019. And what you see here is that out of our 189 members, about 180 are in that position in 2020, and then very gradually that number declines very gradually over the years. Now, the other aspect that I want to emphasize is the divergences that we have seen in this recovery. And we're going to see more of that. And when I say divergences, these are divergences within countries, and it's also divergences across country groupings and even within country groupings, including emerging markets. And I'll develop that theme as I go along. So here, what you see is the within country divergences. This has been a crisis that has had huge distributional aspects, with contact intensive sectors being a lot more affected. And this is true for both advanced economies, but also for emerging and developing economies. The low skilled workers here are the ones who had been affected the most. And there is a similar story which holds in both groupings when it comes to prime workers as opposed to the young. Now, then if we turn to the divergences across countries, this is, I would say, even starker. What this chart shows you is the projected GDP losses relative to the pre-COVID forecasts that we had by region. And again, this is based on our most recent forecasts. And what you see there, that as the world as a whole is expected in 2022 to still be about 3.5% below that level. But that corresponding number for advanced economies is smaller. And even within that, the numbers for the US, the picture for the US looks much better in relative terms than, for instance, for the euro area. And the same type of variation is something that we see in the emerging market. I mean, if you just look at emerging Asia, and if you exclude China, we're talking again of sizable losses, GDP losses, relative to that counterfactual if we had not had the crisis. Latin America comes next, and then of course there is Sub-Saharan Africa and so on. But even within country groups, we see within regions we see that divergence. And then the question is, why are we seeing this, and what are the implications of it? And there are two aspects that I wanted to emphasize in this respect. One of the sources of that divergence is linked to the path of the pandemic and the speed with which economies, different countries are going to be able to vaccinate their populations. And here what we have assumed is that advanced economies and some emerging markets would be able to have widespread availability of the vaccine this year in the summer or the second half of this year, whereas other emerging markets, typically the smaller ones, and of course low-income countries, that mass vaccination would be pushed much later in 22 and sometimes even beyond. Now, it is even within emerging markets, we have some that are producing vaccines, and they're much more likely to move with this process faster. There are some economies that have secured or they've tried to secure enough vaccines for their whole population, and others where they're way below that threshold. Now, also the way the vaccination campaigns had been rolled out, there's huge variation across countries. And all of this, what it means is that that is going to be an important source for that divergence that I was talking about. And by the way, just so that to highlight that there's a similar issue on the demand side, the attitudes towards having a vaccine varies a lot across countries. Now, the other aspect where, again, we've seen a huge variation and divergence across countries has been the ability of economies to provide support, to provide policy support. And part of that is fiscal, the other part, of course, is monetary and so on. What this chart illustrates is just the share of countries in each income group that have been able to do income support of 50% or more. And then here what you can see is that emerging markets, of course, had not done as well as advanced economies, but they still have been able to do a lot more than low-income countries. And here is the place to also talk about more broadly about the policy response in emerging markets. Now, I'm sure if many of us had been asked this question, how at the start of the crisis, how much would we have expected emerging markets to do in terms of using their fiscal space and using fiscal policy, and also what they would have been able to do on the monetary side? I think I would say personally, I just had been incredibly surprised by how much more we had seen relative to what we had expected. And, you know, just to, with a big part of the story, I think, has been that the advanced economies, essentially the Fed and the other central banks, with their very forceful initial response, changing the financing conditions globally has been a big part of that of that story, which has allowed emerging markets to follow suit and to use, you know, to have a pretty sizable interest rate cuts, to also have been able to implement asset purchase programs and so on. And in addition to that, you know, the swap lines that the Fed rolled out, I think, were also very, very helpful. Now, when it comes to the use of these asset purchase programs, what we have noticed there is that we have about 27 of them in emerging markets and developing economies. The preliminary evidence that we see from just analyzing the experience with that is showing that it's really the countries that actually had more flexible exchange rates, that have inflation targeting frameworks, the ones that had, I would say, better policy frameworks more generally, including fiscal ones, have been the ones that had implemented these programs, which I guess is a broader lesson that you know, having the good policy frameworks helps, including in the ability to respond to a shock like this one. And then if we move more broadly to the fiscal policy response, again, I wanted to emphasize the apart from the size, which has been quite impressive in emerging markets, again, the variation of that across economies. And here, I pulled out the numbers because I just find them fascinating, just comparing Brazil and Mexico. I mean, if you look at Brazil, the above the line fiscal support that was provided was of the order of 8.3% of GDP. The corresponding number for Mexico is 0.7. And then the below the line support in Brazil was 5.3, and in Mexico it was 1.3. So all these things play into the way we see the recoveries emerging, and also what the prospects are going forward. Now, where is this all leaving us in terms of what comes next? Now, I think the big question when it comes to the reaction of EM policy, macroeconomic policies, monetary and fiscal, is to what extent they're able to be as effective going forward as they have been so far. And I think this is where this whole theme of divergences comes in. You know, if we imagine a world in which the advanced economies lead the cycle and they're the ones that emerge from the pandemic sooner, what should we expect about financial conditions going forward, including for emerging markets, and whether we shouldn't also expect, and maybe we already see some signs of that, of increased differentiation across countries. And a related and I would say equally important issue, of course, is to think about the legacy of this crisis. And here, I was also trying not to use similar charts to what was presented earlier, but this chart, I think, captures some of the things that Ayhan was talking about in terms of the fiscal vulnerabilities. And this is just the share of countries that we see as having high fiscal vulnerability and medium fiscal vulnerability. And you do see that in both groups, both EMs and also in the low-income countries, we do see a sizable chunk that have high fiscal vulnerabilities, but that share is much higher in the low-income world. But one thing to mention here, and again, this is the counterfactual that we should, I think, consider, is what would those vulnerabilities had looked like if they hadn't been the support that the economies had provided. So the collapse in GDP that we would have faced, I think, at least in the short term, would have, I think, also increase debt levels just because of the impact through output. Now, all of this is not to say that we shouldn't think about the future and should not be prepared, including with having the right frameworks and such, in case those vulnerabilities play out negatively. And the other aspect of this is, of course, to as soon as the recovery is firmly entrenched, to move towards the medium-term retrenchment within having, within credible policy frameworks. Again, I know it's easier said than done, but I think there is little choice, I think, on that matter. Now, when it comes to other legacies of the crisis and scarring, as was referred to earlier, that I think we should think about, one is related to the corporate sector, because what we have seen so far is that there have been moratoria on bankruptcies. I think which is the right thing to do in the short term, but we also know that putting in place the type of insolvency frameworks that are needed to resolve some of these issues can take a long time. And so having that done earlier rather than later, I think, would be incredibly important. And a third aspect of scarring that I do want to emphasize, which is, I don't have a chart on this, but we can see it in the data, that when it comes to the educational aspect and schooling part, emerging markets seem to be a lot more affected than advanced economies. And I think, so thinking about the human capital part of this would be very important. Now, again, putting this all together and thinking about what is the best solution, or what are the solutions to minimizing some of those risks and minimizing the chances of scarring. I think some scarring is inevitable. I mean, some of these economies, they have different dependence on tourism, on commodities. sectors that would take a long time to recover. They've had different starting positions. They've had different ability to mitigate the shock. So some of that will happen, but ultimately, having the path of the pandemic under control and really vaccinating everyone across the world from a very practical and I would say even selfish point of view for the advanced economies, I think is what makes sense. Because what we've found is that the longer the pandemic lasts, the bigger scope there is for mutants to emerge. And it's just a classic case of having a global public good. So this is where this whole issue of how the production of vaccines will play out and whether there is a scope for more cooperation there across economies, and including a place where emerging markets can play a role in terms of expediting that, I think would be something to consider. Our own estimates show that if we were to really have that availability of vaccine earlier than what is in our current forecasts, the total positive impact of that by 2025 is in the order of like $9 trillion. And with about 4 trillion accumulating to advanced economies, and of course the rest to emerging markets. And again, thinking about scarring, what we also know from history is that the larger the initial shock and the longer lasting it is, then the higher the chances of scarring. So this is why we also emphasize the importance of not withdrawing support too early, and having clear signs that the recovery is taking hold, and then pivoting towards policies that would also be able to support a reallocation, which would be inevitable in some shape and form, given that the new world is going to look quite different from the pre-COVID one. Let me stop here. Thank you.
Thank you very much, Petya. Let me turn it to Steve. I'd like to come back, though, with the general question. Once Steve has presented, I'd like to get everybody's view on the world economic outlook. But let's pass it on to Steve.
Thank you, Desmond. It's a great pleasure and honor to share this virtual podium with such distinguished folks and I dare say distinguished experts on the topic of the global economy. I'm just going to go ahead and share my slide deck, which seems to have skipped more than a few slides, so excuse me. Okay, there we go. Anyway, I don't want to minimize the cost of the global pandemic in terms of human lives or livelihood lost, but I would like to address an issue that has actually come up a lot in our discussion so far, which are the financial stability risks of increased fiscal deficits and fiscal debt as a result of the pandemic. And kind of what I've been wondering about is to what extent those risks are mitigated by the fact that we're now in an environment of very low global interest rates. I'll be focusing on the emerging markets rather than the more fragile low-income economies that Ian's highlighted. And to skip to the bottom line, the answer to that question that I came up with is more damage than I would have thought or would have hoped for, but perhaps less than you might think. So with that, let me start with by trying to move my slides. Okay, so I want to start by referencing a very nice paper by Jason Furman and Larry Summers that focuses on the rise in US fiscal debt ratios and notes basically that because real interest rates have fallen so much in recent years, the overall debt picture remains sustainable. And, so what they argue is a stock of debt by itself is not a sufficient statistic to assess debt sustainability. And you really need to look at the interplay between interest rates, growth, fiscal deficits, and debt. And, toward that end, since you made nobody promise that we would not use equations, I have a few, or actually just one. This is the standard one for debt dynamics, the change in debt to GDP ratio, is equal to, R minus G, the real interest rate minus GDP growth times the debt ratio plus the primary deficit. And I find it convenient to basically separate the R into G into two different pieces, as shown here, to focus on the R times debt to GDP. And then I like to separate the real interest rate into the nominal interest rate I minus inflation pi. And then to basically break that up and move the pi over to the other side. So then I can focus on what I'm interested in, which is this nominal interest rate times debt to GDP, which is basically a measure of interest service burden. And oops, actually I didn't want to, well, let me just skip that. Anyway, and then basically what I want to ask is, has that interest service burden risen or fallen since the advent of the pandemic itself? Now, it seems to me that for the US of A, the answer is pretty clear, despite the many corners that I've cut in this simplistic example. The 10-year Treasury yield has fallen from 1.6% at the, in January of last year to about 1.1% now. And that's a much larger decline in proportional terms than the rise in the US debt to GDP ratio, which the IMF has as going from 108% in 2019 to 132% in 2021. So in consequence, if all the debt were basically being, serviced at the current 10-year yield, the interest service ratio for the economy would fall from 1.73% to 1.45%. So with that, what I wanted to know, so obviously, so U.S. debt sustainability looks better by this metric. And what I was interested in is, what about the emerging market economies? Okay, have they benefited to a comparable extent? Okay, and so we need to look basically at their changes in interest rates and their changes in debt. So starting first with this figure, this is basically dollar interest rates that are faced by emerging market economies, and the gray bars are the actual 10-year Treasury yields. And as you can see, they've fallen a great deal from January of last year to January of this year, though they have regrettably picked up a little bit more recently. But of course, emerging markets don't pay the 10-year yield, they pay that plus a spread, which is the blue bars. And that spread has actually gone up a bit, okay? So that the all-in dollar interest rate has declined for emerging market economies, but not by a huge amount. Okay, and now let's take a look at individual economies, okay? So each dot is an economy, an emerging market economy. The x-axis represents that economy, the dollar interest rate that economy faced in January of last year, and the y-axis shows it January of this year, so that dotted 45-degree line means they're about equal. Okay, and the point is that a lot of economies did experience a material amount of dollar interest rate reduction, but three economies that I will continue to be identifying in the rest of my talk: Brazil, South Africa, and Turkey, not. Okay, and unfortunately, the dollar interest rates are not the only thing relevant to emerging market debt, because most emerging market governments have also issued lots of domestic currency denominated debt, and those yields have not fallen so much. And it's kind of a mixed bag. Some economies like Mexico and Indonesia have experienced declines in domestic currency interest rates, while other economies like Brazil and Turkey basically not so much. So this again now repeats the exercise we did before, but looking at domestic currency interest rates. Again, most economies have experienced some, not huge, decline in domestic currency interest rates. But Brazil and Turkey, they have gone up, and South Africa about the same. So that's all the interest rate side of the ledger. Now let's turn to the debt side. And as I and others, everybody in the panel basically has noted, sovereign debt has indeed gone up plenty as a result of the pandemic. okay? And again, looking at our familiar chart, relating debt to GDP in 2019 now to the IMF forecast of debt in 2021, it's pretty uniform across all countries. Okay, so everybody's debt has gone up. Most countries' interest rates have gone down. So how do we put this together? Well, that's what figure 7 is all about. Okay, so the x-axis shows the ratio of the projected 2021 gross fiscal debt, as projected by the IMF, relative to 2019 debt. So, and then the y-axis shows the ratio of basically the recent January 2021 interest rate, which we're assuming will prevail for the rest of the year, ratio of that to the year ago interest rate before the pandemic. So, so clearly, so basically, and let me just note that the interest rate that is referenced on the y-axis is a weighted average, okay, of the domestic currency interest rate and the dollar interest rate, weighted by the each emerging market economies, government's share of domestic and foreign debt, respectively. So taking a look at that, obviously all economies in the northeast quadrant, that's like Brazil and Turkey and others, have basically, from a debt perspective, suffered as a result of the pandemic. Debt has gone up and interest rates have gone up, okay? Countries in the southeast quadrant, that's a little bit less clear. Debt has gone up, interest rates have gone down, and it was fun to ask my excellent research assistant, John Kearns, to ask to put in this swooping red line, which represents the locus of points at which the proportional increase in the debt is exactly offset by the proportional decline in interest rates. So any country on that line, basically it's a wash. Their interest service doesn't change. And then for those under it, like Mexico and Taiwan and Hong Kong, those are countries that actually lowered their putative debt interest service, okay? So for those who tire of this fun with graphs and actually just show me the calculation for interest payments as a result, as a share of GDP, I will oblige, all right? And so the y-axis looks at this putative, and I say putative because it's the change in this 1 10-year interest rate multiplied times debt. The change in that from, calculated from 2019 to 2021. And then I'm just, because I got to graph against something, I want to graph it against the, the projected 2020 debt to GDP ratio. So the point is, if you have lots of debt on the x-axis and your interest payments to GDP have gone up a lot, the y-axis, that's not so good. And as you can see, what you can see is for several economies, again, like Turkey and South Africa and Brazil, you have, either the debt is high or the interest payments have gone up a lot. But for most economies, not so much, actually. They're all kind of like at or below, an increase in debt service of about 0.5% of GDP, which is, it's material, but I think it is manageable, okay? And that would be consistent with Ian's suggestion that for emerging market economies in general, as opposed to like low-income economies, the issue is not egregious at the moment. Now, of course, as I keep on mentioning, these calculations are a little bit esoteric in the sense that they multiply this, a 10-year interest rate times the debt stock, doesn't take into account legacy debt, which is paying higher rates and which can't change the rates, et cetera, et cetera. So now what I've done is I have superimposed on that chart the calculations of interest payments from the IMF, okay? So for every one of these red dots is the IMF projection for interest payments. The debt to GDP on the x-axis is always the same. So so the red dot is always in the same vertical line as the blue dots, and they're generally always above. So in other words, the blue dots, my calculations, kind of like represent the best you can do if you refinance everything at the prevailing interest rate, and the red dots show actual increases which are going to be bigger because a lot of the debt actually, is being charged at higher rates. But basically, even if you focus on the IMF estimates, the red dots, most of the observations are still below 0.5% of GDP, meaning even by this metric, the kind of like the interest load as a share of the economy doesn't go up all that much. Okay, and so that's something I want to keep in mind. And so actually I say thanks, but that's a little premature. I have a few concluding remarks once I can stop sharing my screen. All right, so anyway, so I've kind of like already given you the bottom line. For most economies, it looks like, based on what we've seen so far, the damage to fiscal sustainability, not so great. But certainly it is for some countries, like I mentioned before, Brazil, South Africa, Turkey. And it's also true, and I haven't talked about this, that as I and others have mentioned, a lot of governments were already pushing into higher debt even before the pandemic. So maybe even smaller increases in debt service loads will be difficult for them. But all told, as I say, the situation right now doesn't look like imminent crisis, and that kind of like supports the IMF and World Bank view that the time for austerity is not now. It is basically once the virus is vanquished. Okay, and so the policy recommendation, from this analysis for a lot of countries is take advantage of the easy borrowing and low interest rates to refinance your debt. Low interest rates at long term, lock that in, maybe even borrow more to build up your war chest for more difficult times. And of course, target your fiscal expenditures, on the things that you really need to fight the pandemic, not like ancillary, objectives. I would note as an aside that could be also applied to the United States relief effort as well as that of emerging market economies. And then finally, it's worth emphasizing that notwithstanding my somewhat optimistic calculations, the situation with global capital flows, access to financing, and interest rates could turn on a dime. So basically prudence in the face of possible increases in risk are certainly essential. And I will stop there.
Thank you very much, Steve. We're getting towards the end of our time, so I would just pose one question, I think, to the whole panel. It seems that everybody's agreed that the debt levels in the emerging markets are very high, that their fiscal positions aren't very good. And it seemed that there was consensus that financial conditions are going to stay favorable for a long time. My question would be, how reasonable is that assumption when we've got a fiscal package being prepared in the United States that is $2 trillion on top of another $900 trillion? We're talking about massive fiscal stimulus. We're talking about massive monetary stimulus. My question is, surely this means that at some point, what we're going to have is we're going to have overheating of the US economy, rising interest rates. And isn't that something that then changes the financial conditions of these emerging market economies? So, my question is, are we perhaps understating the risks, given I'm not saying that there shouldn't be fiscal stimulus. I'm just talking about the order of fiscal stimulus. We've never seen anything quite like this. We've never seen monetary expansion at this pace. How plausible is it that financial market conditions stay good? And then it's not just the emerging markets, it's that we've got bubbles everywhere in the global economy. So I don't know if we want to go through that. Maybe if each person can just say, why don't we just go in the order in which the speakers spoke? Ian, do you want to say something? And then let's just go to Alberto. And we've got around about 10 minutes to do this.
Thank you, Desmond. I think Alberto and Petya and Steve would all agree. You are asking the kind of the $1 million question.
It's actually the $3 trillion question.
Yes, we should maybe it's a $1 trillion question. Yeah. So the challenge here, when we think about really this debt tolerance of countries, and on the one hand, and on the other hand, the kind of the how long you will have a sustained high growth. Those two will ultimately determine the implications of these policies in advanced economies. Yeah, you can have $3 trillion, $4 trillion stimulus packages. The markets believe that the US economy can carry that type of debt load. And there is supportive liquidity conditions out there. I think things will remain as they are. At the same time, of course, you might see some increase in long-term interest rates with consequences for all types of other variables, possibly inflation as well. The second item I mentioned is basically what will happen when you have this type of rich stimulus package to economic growth. Whether you will have high growth for an extended period of time, and you will see the type of overheating in the economy we were talking about that will force the Fed's hand to intervene. That has to be seen as well. I think the big issue is in this environment of very accommodative fiscal and monetary conditions, whether emerging market developing economies can take advantage of the moment and get ready the kind of the increase in interest rates. And that will happen sooner or later. Even if it doesn't happen at the global level, it will happen for some countries. And I think Steve already identified them. All these outliers in his graphs are going to be subject to all challenges if market perceptions change. I talked a lot about the potential growth, and that is critical because obviously there will be growth this year because of accommodation. But when that accommodation is no longer there in this scale and scope, whether countries can generate growth and say the financial markets, look, we are able to pay back what we borrowed. And we should worry about that, the ability to pay back in an environment, your ability to grow is getting more and more limited. We did quite a bit of calculations. In the case of Latin America, Alberto knows very well, there is a huge challenge in the context of potential growth. But let me stop there. Thank you.
Alberto.
Yes, absolutely. You ask if these extraordinary monetary conditions will last forever. The answer is no, they won't last forever. They should not last forever. It would be a very sad state of the world if we need them to, to last forever. Once, this monetary accommodation is removed, how damaging is that to emerging markets and to the debt dynamics? It really depends a lot about the broader context in which dollar yields go up. If it is associated with a firmer growth profile in the US and the global economy, and the repricing of global yields is not abrupt, EM, and particularly in the FX space, in the exchange rates, they tend to absorb it relatively well. If it is more a change of views about the policy response function of the Fed, or some cost push pressures, that lead to this earlier normalization of monetary policy, is a lot more damaging. But I think, what is important for us to focus is that this will not last, right? And because this will not last, I have a somewhat less sanguine view than Stephen with his calculations that are very well done, very comprehensive, that, you have more debt, but I lower the cost of that, enjoy it, right, in the short term. But it reminds me of the analogy, like rates are low and you go to the bank, hey, why don't you borrow, take a second mortgage, buy a second house? You can afford it. Yeah, you can afford it now, but will be able to afford it 5 to 10 years from now. Your income will be growing at the secular trend. Rates will normalize. I think we have to do at least this dynamic calculation, about eventually borrowing too much too much in the short term. So I'm a little bit concerned. And even in the short term, many of these countries already had debt challenges. And even though the situation may not have been more severe in the short term, if they had done a little bit better, they have reduced that burden in the short term. I think, mentioned like the case of Brazil, first and foremost, is an extremely complex case. It comes across, clear in Stephen's chart. So I'm a little bit more worried, and I will be also a little bit more cautious in taking a somewhat benign view that in the short term, because yields are lower, because that is the broader external backdrop that many EM countries are facing. If you allow me to go back to my lousy analogy of an economy carrying a boulder or a big rock on their shoulders, it's like, well, you're on your journey and they put you like here goes another 30 pounds on your back. But worry not, you're going to be driving downhill. The external backdrop, yields are lower. So how does it feel? Well, I have more weight, but I'm driving downhill. But the road will not be downhill forever. And when the road levels off, or you go up, you still be carrying your 30 pound, extra weight. So I'll be a little bit more, careful. I mean, the debt dynamics are what they are. It's pretty clear. It's pure and simple arithmetic. But one of my concerns is about the dynamic implications of carrying too much debt, beyond the issues that I mentioned at the beginning, that having too much debt slows you down, makes the macroeconomy more volatile, reduces the efficiency or the potency of the fiscal instrument and the other issues around it.
Thank you. Petya.
Okay, let me maybe make a few points here. First is that the new stimulus package is not something that is incorporated in our current baseline. So the numbers that I showed you earlier do not have that effect. Now we have, and of course, we do not have the final package, and we don't know exactly what it would look like. But we, in our very preliminary analysis of its economic impact within the US, we arrived at a number of about 5% of GDP over 3 years. The part that we have not done yet is to think about and to really do the analysis on the spillover effects of that through some of the channels that were already mentioned. Now, we do have parallel analysis, which will not surprise you in terms of what it shows, that when you have surprises that come from the monetary reaction function of the central bank through the risk channel, then the impact on emerging markets is negative. But if it comes from good economic news and such, then of course the trade channel and more broadly the confidence that comes in could actually be quite positive. Now, I know that this is not, this is the typical one hand, two hand type of answer, but what I would say, and I very much agree with what was said previously, that either way, the implication for emerging markets is to take advantage of the very benign conditions now, and doing some of the things that Steve mentioned in terms of just locking in the rates and extending duration, and that is in some ways a no-brainer. Thank you.
Thank you. Steve, you can have the last word.
All right, well, well, for starters, so I want to make sure it's understood that kind of like the exercise I went through, was meant more to highlight some of the kind of like qualifying factors associated with low interest rates, not to say, well, emerging markets are now good, there's no problem, because they clearly have increased their debt. And as I say, for most economies, the immediate effect of the higher debt shouldn't be damaging, but it does pose extra risks. And clearly, if interest rates were to go up a lot, surprisingly, that could indeed upset the apple cart. And you can think of three scenarios. One of them is greater U.S. fiscal deficits and debt lead to a run away from the dollar and soaring dollar interest rates. I think that you're agreeing, Desmond.
No.
Okay. Well, I'm just saying, I don't think that's that likely. We've got the world's, vehicle currency, and they're stuck with it. And then there's two other ways that interest rates could go up. and Petya and Alberto have both referenced this. Greater, surprisingly good global recovery could lead to higher interest rates, and that would be and that would probably not be that injurious for all but the most vulnerable economies because it supports their ability to service the debt. Conversely, some type of monetary shock, either a monetary shock, the Fed turns hawkish, this seems unlikely, or some kind of inflation shock forcing the Fed to react. Either of those events could indeed upset the apple cart and lead to big problems for emerging markets, and that's certainly the case. And I would note that while Petya and Alberto have both preceded me in advancing that kind of like dualism, I've got a paper with a couple of co-authors already at a journal that proves that. And so, I don't think that their comments should come in the way of our article being published. And I will end with that self-serving reference.
So it really just remains for me to thank you all for a great discussion, and maybe we can do this again in 6 months' time. See where we are then. Thank you very much.
Thank you,
All right.
Desmond.
Thank you.
Thank you.